Get your free copy of the complete tutorial at www.teachucomp.com/free. Next, we will take a look at preparing the financial budgets. The cash budget shows the company's anticipated cash flows for the period. This budget is considered to be the most important financial budget since cash is usually the most important resource to a business. The cash budget contains three sections: the cash receipts, cash disbursements, and financing. Also note that this budget is typically prepared last because information generated by the other budgets dictate the expected cash flows. Even though our example for XYZ Inc. doesn't contain numbers, we can use this as a good example of a cash budget. The cash receipts section includes expected receipts from the principal sources of revenue. The cash disbursements section shows expected cash payments. And the financing section shows expected borrowings and the repayment of the borrowed funds plus interest. It's also important to note that manufacturing companies and merchandising companies use different budgeting systems. A merchandiser uses a purchase budget instead of a production budget. They also do not use the manufacturing budgets. The merchandise purchase budget is budgeted cost of goods sold plus desired ending merchandise inventory minus beginning merchandise inventory, and this will give us the required merchandise inventory. It's also important to take a look at service companies and nonprofits and how they use financial budgets. Service companies have a different style of budget than companies who produce goods. The critical factor in these types of budgets is coordinating professional staff needs with anticipated services. It's important to have the correct ratios and amounts when determining budgets in order to keep costs low and in order to not overstaff a business. Service companies can obtain budget information for service revenue from expected output or expected input. While budgeting is just as important for nonprofit companies, the budget process is a little bit different than for-profit companies. Most not-for-profit companies create the budget on the basis of cash flows, such as expenditures and receipts, rather than on a revenue and expense basis. Furthermore, the starting point in the process is usually expenditures, not receipts. For the not-for-profit companies, management's task generally is to find the receipts needed to support planned activities and actions, instead of increasing revenues. Like what you see? Pick up your free copy of the complete tutorial at www.teachucomp.com/free.